Hey guys, this is Rudy for Investor Investor. There's a lot of talk in the marketplace about things that matter to us, the macro on global oil, obviously in general. ESG as a topic of discussion is becoming more and more prevalent every single day. And of course, there are things that go along with that, like electric cars. So I thought, why not put all three of these together in one video? And if it's not educational, who knows? Maybe it's entertaining. But what the heck, Let's try it and see where we end up, and see if we can find some agreement between ourselves about anything at all. So the first thing I want to do is take a look here at Real Clear Politics. Now, don't judge me because I didn't choose Real Clear Politics. This just came up as I was kind of reading about ESG. So I thought, hey, you know what? There are some people in our community who might be interested in what these guys say, whomever they are, whatever they might believe. I'm indifferent. The gigantic holes in anti-oil ESG activism. Well, if you use clickbait like that to attract my attention, I'm probably going to read it. Let's start with the obvious. Oil is the world's most important fuel, supplying 35% of all energy and over 95% of transportation needs. More than 6,000 everyday products contain oil as their core ingredient. Simply put, oil has no significant substitute, and it won't for a long time. Massive amounts of wind and solar won't displace black gold because these sources compete only in the power generating sector, where oil effectively plays no role. Most Americans probably don't even realize that electricity had already lost the transportation race to oil and its powerful derivative, gasoline, 120 years ago. Well, here's surprise number one. In 1900, who knew, right? I mean, like in 1900, if you're as old as I am, you could say like, I was probably having tea with Thomas Jefferson or something. Anyway, that's an extra 200 years prior. But anyway, in 1900, nearly 40% of US cars were electric. Who knew? Did you have any idea? Like in 1900, nearly 40% of all US cars were electric. Now, being suspicious by nature, as soon as you tell me something like that, I need to immediately dive deeper and say like, I got to check this out. And I will. And I did. And I'm going to share that with you in just a second. Today, less than 1% of cars run on electric power, approximately 2 million cars out of 270 million. Despite the huge subsidies thrown at the industry over the past 10 years, electric vehicles remain largely toys for the rich. Well, I don't know too much about that one. I'm not too sure on that one. I think they are trying desperately to get the price of electric vehicles lower. Of course, if they remove the subsidy, then the car is instantly significantly more expensive than anything else that is a combustion engine, comparatively speaking. As the world's economies rebound from COVID-19 and travel inevitably picks up, the need for more oil is becoming even more pressing. After the oil industry set a global demand record in 2019 at 101 million barrels per day, the pandemic plunged demand to 92 million barrels per day in 2020. The Department of Energy, however, has just forecast that consumption will rise to 98 million barrels per day this year and above 100 million barrels per day in 2022. 100 million barrels per day is sort of peak oil, and we're getting close to there right now. So I'm not going to bore you with the entire article here. Maybe it's not boring. I don't know. You guys can find it if you want. It's Real Clear Politics, the gigantic holes in anti-oil ESG activism. In fact, I'm not even going to talk much about ESG activism. You can kind of see where this thing is going for yourself. But remember that line that I showed you just a minute ago? In 1900, nearly 40% of US cars were electric. Well, let me see about that. 38% of American cars were electric in 1900. Who knew? Like, I had no idea. In the modern era, we may assume that electric cars are new technology. The Chevy Bolt, Nissan Leaf, and all Tesla vehicles are currently cutting-edge automobiles, right? But there was a period in America a long time ago when about 30% of all cars were electric. Today, only about 1% of the fleet runs on electricity. This one you can look up in Clean Technica, cleantechnica.com. So how about this, huh? In our modern era, so I just read that, so let me read it again. Electric cars were first created in the early to mid 1800s. In 1898, Dr. Ferdinand Porsche, we know who that guy is, right? Well, I haven't met him. I'm not that old, but we know who Porsche is. When 23 years old, built his first car, and it was the Lohner Electric Chase. Also in 1898, Count, let me try this one as French, Gaston de Chazolou-Labat of Paris set a world speed record in a car which happened to be his electric Janton. I'm probably destroying the French language, but you could probably forgive me. English is my second language, never mind French. The speed record was 39 miles per hour, but that was crushed just a few days later by another electric car. It went 65 miles per hour. That's very impressive for like 1898. It says, well, that's a bit of a weird image here. By 1900 in the United States, 38% of automobiles, which is 33,842 cars, were powered by electricity. 40,000 were powered by steam, 22% by gasoline. This information may sound like some crackpot internet hoax, but if you look at the sources, you can actually see that they are credible. Well, that helps. The US Department of Energy. All right, is the US Department of Energy a credible source? I guess it's more credible than CNN, huh? Their page on the history of the electric car states, this is a direct quote from the US Department of Energy. By 1900, electric cars were at their heyday, accounting for around a third of all vehicles on the road. And during the next 10 years, they continued to show strong sales. By 1912, there were 38,843 electric vehicles on US roads. Why? Horses, steam-powered cars, and gas-powered cars were also available at that time, but electric cars were appealing to some women. Did women drive in 1900? I'm not sure. Who preferred the quieter rides and the fact that electric cars started more easily. There was no crank to push and pull like gas mobiles of the time. Additionally, there was no smoke. There were no smelly fumes, and there was no gassing up. A New York Times article, there's another credible source, from about 1911 described this preference. In around 1914, Henry Ford and Thomas Edison were collaborating on an electric vehicle. Within a year, I hope, this is a quote, we shall begin the manufacture of an electric automobile. I don't like to talk about things which are a year ahead, but I'm willing to tell you something of my plans. The fact is that Mr. Edison and I have been working for some years on an electric automobile that would be cheap and practicable. Unfortunately, if not tragically, this project fell by the wayside. One can only imagine what might have happened if Henry Ford had begun producing some simple, affordable electric cars along with the gas mobiles his company turned out in huge numbers. One of his experimental electric vehicles actually used a Model T frame. So I'm not going to go on with this article either. As I said, you could look it up on cleantechnica.com if you are really interested. But I had absolutely no idea. And every day I surprise myself with how little I know. Anyway, on a more serious note, this is Mckinsey. This is their latest study on global oil supply and demand outlook to 2040. So let's just look briefly at their 5 key findings and then we'll wrap it up. Demand recovery to 2019 levels is in sight. Liquid demand is likely to return to 2019 levels by late 2021 or early 2022. Slower demand recovery would be due to a slow vaccination rollout or if COVID-19 control remains a potential risk. Next finding, oil capital expenditures are unlikely to fully recover. Well, we know the guys have cut back on CapEx quite significantly. Investments in oil capital expenditures are expected to gradually recover but remain below pre-COVID-19 outlook. We expect a slow rebound in shale and offshore in North America. Key finding number 3, long-term oil demand is exposed to large variations across all scenarios. After more than 30 years of stable growth of more than 1% per year, oil demand growth slows in the late 2020s and peaks in 2029. Various energy transition drivers could cause peak to occur 6 to 10 years earlier. Now, guys, this is actually an important point. They are saying, and I'm not sure if they're going to be correct, but they're saying that growth slows in late 2020 and peaks in 2029. And of course, 2029 is like a lifetime away in terms of cyclical oil demand and supply. But various energy transition drivers could cause peak to occur 6 to 10 years earlier. We need to stay on top of this so that you make sure that you have an exit strategy that matches your required investment return. So this is something that you need to pay attention to. In addition to listening to Mr. Oxy, you need to decide at what stage am I happy to exit whatever the position is. If you make a lot of profit, you can always exit some of it, take back your own money, and then just play with the house's money and see what happens after that. But anyway, you need to be able to not only do your own due diligence, but also decide when is the right time for you to exit, rebalance, or whatever it is that you need to do, especially based on your earnings, your age, your expected return on investment, etc. Those are things that only you know and that only you can control. 38 million barrels per day of new oil drilling is needed to meet demand by 2040. By 2040, exploration and production companies need to add 38 million barrels per day of new crude production from unsanctioned projects to meet demand. Most new supply is expected to come from offshore and shale resources. Okay, take note once again. That's key finding number 4. And then the last one on the right at the bottom. Even in an accelerated energy transition scenario, you will see need for new oil drilling by 2040. While most offshore oil producing regions will be under pressure in an accelerated energy transition scenario, the sector will still require new production of nearly 23 million barrels per day to meet demand by 2040. Demand in a 1.5 degree Celsius pathway will force shut-ins. So that's a mouthful of stuff they're sharing with you, but very quickly, 5 key findings. Demand recovery to 2019 levels is in sight. That's good news. Oil capital expenditures are unlikely to fully recover, not in the near term anyway. Long-term oil demand is exposed to large variations across all scenarios. I think we know that. 33 million barrels per day of new oil drilling is needed to meet demand by 2040. So demand will keep rising, especially as developing countries develop and populations grow. And we know that the huge population growth in the future is going to be predominantly in Asia and Africa, and they will be consuming and burning fossil fuels like there's no tomorrow. And then the last one, even in an accelerated energy transition scenario, we see a need for new oil drilling by 2040. So guys, there you have it in a nutshell. The first part, wherever you sit, whether it's on the fence or on either side of the fence in terms of ESGs, you can always let us know in the comments. I had no idea, as I said, that there were electric vehicles on the road in 1898. So as I said at the start, I learned something new every day. And you just had a quick overview of McKinsey's 5 key findings as it relates to global demand. So, if nothing else, as I said, if it's not educational, maybe it's entertaining. I hope you enjoyed the video. If you like it, please subscribe, and I will see you guys again soon. Take care. Bye-bye. This is Rudy for Best Investor saying time out.